Joe, I think this is actually important because the term pivot has been defined three separate times by markets. First, it meant rate cuts. Then it meant pauses in rate hikes. And now it means just reducing the rate of increases. And that's all the respondents to the CNBC Fed survey are forecasting at this point. And that pivot or pirouette or swivot doesn't come until December. Here's the Fed expectations chart from our CNBC Fed survey. 75 this month, goes down to 50 next month. That's your swivot right there. The peak rate hike comes 483 in March 2023, but the Fed stays at that rate, according to our panel, for 10 months. Tom Kosterg, senior U.S. economist at Pictet Wealth Management, writes in, let's not get too excited about an imminent Fed pivot. We're not yet arriving on the finish line. Consumer inflation expectations are still way too high, and core CPI is likely to be sticky for several months due to rents. We asked the 35 respondents, they include economists, strategists, and analysts, what it would take for a real pivot. That is, for the Fed to start cutting rates, and the bar looks to be very high. The average CPI rate needs to be 2.6% for 5 months, an unemployment rate of 5.3%, and GDP falling to 2.2%. Here's the rate outlook according to the panel. It's very close to where the market is right now. End this year 4.4%, peak rate of 4.8. And then at the end of that 10-month period or around there, the Fed does ease back a little bit and eases back a little bit the year after that in 2024, 3.3%. The consensus is that the Fed creates a recession through its rate hikes. There are also growing concerns about stress in fixed income markets from both rate hikes and the balance sheet runoff. 63% seeing systemic risk as somewhat high and 9% seeing it as very high. Joe?
Okay, Steve. We got so used to data dependency, it's just hard for me to. I guess it depends on what data you decide to focus on, and that's obviously it. What we talked earlier, Steve. We had 2 negative quarters, small, due to weird factors. We had 1 positive due to maybe one-off factors. What's the last 3 months, the last 3 quarters, what's the real average? What do you think GDP has been for an average annualized over the last 9 months? 0?
I haven't calculated that,
1?
But
not actual numbers.
Probably slightly. Yeah, go ahead.
Not using the data we have, not using the 2.6 and the 2 negative, not just
the real thing,
but the actual. Yeah. If you just back out the weird things, the inventory buildup, the pandemic-related effects, what kind of economy are we really talking about? And what I'm arguing for is that maybe it's already pretty slow. So if killing it even more, where the benefits of whether you cure inflation, you don't even know whether you're doing that. And if you already have a pretty slow economy, I think you need to think about that.
Well, it's more worrisome, Joe, right? Because let's say you're right, and I think that may be right to come up with like a 1% figure if you get rid of all the noise around GDP over the 9 months, and you still haven't really had much of an impact on inflation. I mean, core headline CPIs come down a bit, but the core has been very sticky. You have that lingering rent inflation problem. If we're really slowing the economy below trend and not getting much response on inflation, that's got to be worrisome. That's got to tell the Fed it needs to lean even harder. And the trouble, Joe, is that the Fed only just now became restrictive. That's why it was going in 75s. It wanted to get to a place where it was actually putting brakes on the economy, and it's only been a few months while that actual braking has been going on.